Okay, put call parity. You have already started with Vincent to talk about put call parity, right? You have last time what you actually realized that when you have an at the money call, then, and you look at the at the money put, they have the same value. Or if you have seen, we have seen these two option drivers, volatility value and parity value, and we have seen that options with the same strike, the same expiry, and the same underlying have actually the same volatility value. We are reviewing that by doing an exercise about that. And this is the absolute typical exercise. And I think if you can do that exercise, you really have understood put call parity. Everybody here probably consumes put call parity a little bit different. So I will show you how I do that, but you can do it with a formula or whatever, however you want to do that. So you see here the situation. You have an underlying that trades at 200. We have interest rates 5%. The underlying pays no benefits. This is just to make my calculation simple. And we have options expiring in 1 year. And then we have two options. We have a call and we have a put with the same strike. The call costs 15, the put costs 10. And the question is, are these prices in line with each other? We know that put call parity sets a relationship between the price of the call and the price of the put. And then, of course, if they are not in line, if there's an arbitrage possibility, what is the trade? Now, this is quite simple, right? So what we see, one of them have the same strike, the options. One has to be in the money and the other one has to be out of the money. So it seems the call is in the money because it's more expensive than the put. So let's briefly check that. We take the spot, we calculate the forward. Remember when I talk about in the money and out of the money, for European option, the right thing is talk about in the money, out of the money relative to the forward price. So if I calculate the forward price, I have a spot 200, no benefits, interest rates 5%. So the forward is 5% higher than the spot. That means the forward is 210. Okay, that makes sense. The call is in the money because the strike is lower than the forward, which is 210, and the put is out of the money. Now, but I can also see how much in the money the call is, right? If the forward is 210 and the strike is 200. So these two options are at the money spot, but the call is in the money relative to the forward. So the call is in the money relative to the forward by about 10, not exactly 10, we would have to discount that. 10 discounted by 5%, which is about something like probably 950 or so. And so that means the call has a volatility value, an implied volatility value. We do the calculation more precise later, but the call, because it's in the money by roughly 10, it has a volatility value of roughly 5. The put has only volatility value because the put is out of the money. So you see, there is something that is not correct because the call has a volatility value of say 550, 5 or 550. The put has a volatility value of 10. Put call parity is saying that the volatility value of the call has to equal the volatility value of the put if these options are on the same underlying, expire at the same time, and have the same strike. So that means there is an arbitrage. Now, what is the arbitrage? The arbitrage is always the same thing. Rule 1 of investing. Buy low, sell high. So I would buy the thing that is too cheap. The call is too cheap relative to the put. So I would have to buy the call and sell the put. If I buy the call and sell the put, I have synthetically bought the underlying or the forward, and that is risky. So to get out of the risk, I would also sell the underlying, and you have seen that this trade is what we call a reversal. So that is the short story. Now let's do it a bit more precise. So here, the first step is always calculate the forward, because this is your reference point to decide which option is in the money and out of the money. We already did that, and this is 210. Then I take I analyze the call. I analyze how much volatility value the call has. So the call is in the money, that's why it has volatility value and parity value. The parity value is the parity to the forward, discounted. That's about the 950. And therefore the volatility value is the value of the call, the 15, minus that parity value, which is 548. So that is the volatility value of the call. The put, we know the put is out of the money relative to the forward. So the put has no parity value. That means the total value of the put is volatility value. And here you see this discrepancy. The volatility value of the call and the put is not the same. So are these prices in line? No, because according to put call parity, the volatility values, because these options have the same strike or the same underlying with the same expiry, would have to be the same. So therefore, the put is too expensive relative to the call. What is the trade? The trade is I buy the thing that is too cheap, that means the call. I sell the thing that is too expensive, that means the put. By just doing that, buying a call and selling a put, I have bought the underlying or a synthetic forward, something like that. So I have the same risk as the underlying. This is far too risky. I don't want that risk. So to have a smoother P&L, I would sell the spot. Or sell the forward, whatever. If I mean, here we don't know whether the forward is trading, so I said the spot. This is called a reversal, and it is just a name. But it's always the same trade. Either it's buying the call, selling the put, selling the spot. That's what we call a reversal. Or it's the other way around, selling a call, buying a put, and buying the underlying. Then it's called a conversion. So that is put call parity. If you can do those questions, I'm absolutely happy. You don't need to do more. Some people prefer to really use that equation, right? So this is how you have it in your brain. And you could do it, of course, as well. You have here the call that has a value of 15. You have the put that has a value of 10. So if you calculate the left side, you get something like 5. If you calculate the right side, forward 210, strike 200, you get something like 10 present valued, that is 10-ish or 950 or 948 or whatever. And you can see 5, okay, left about something like 10 on the right. That doesn't fit. The equal doesn't hold. So put call parity is violated. The call is too cheap relative to the put, because this number here, C minus P5, is too small relative to the number on the right side. So to pop it up, you would have to increase the value of the call. So that is put call parity, right? The only other thing, if you open a book, what could be that it's written with continuous rates instead of simple rates, but that's just how you consume interest rates then. Cool. See, that's it. And then, as we said, there are two trades, either a conversion and or a reversal. It's always the one or the other one, and you just if you know which of the option is too cheap, then of course the other one is too expensive. You can do that, or of course it could be that they are in line. So that is put call parity. Now, what we of course could do, we could go back to that example Vincent showed us last time, and we could see, hey, in reality, does put call parity hold? Right? And for example, what we could do, we could first look at the at-the-money options, right, here. And you know, at-the-money options are the most liquid ones. And you see it also here, there's some trading today of those. And so we look at the prices. So we could look at what is the mid price here, a bid ask, what is the mid price for the puts, and then see which ones, whether actually we could calculate where is the forward. I've done that. I can show it you on the next slide, but you can easily see it. So for example, the call here is a little bit more expensive than the put. So here, the call and the put are closest to each other, but nevertheless, the call is a little bit more expensive than the put. So that means the call is a little bit in the money. If you actually calculate the mid prices of the call and the put, you see that the mid price of the call is about 1.2 more expensive than the mid price of the put. So that means the call is slightly in the money by about 1.2. That means the forward here should be about 1.2 above the strike. And if you calculate that, you get a forward of 6,061.20. As I said, I did it for you. If you want to check that, again, we are a little bit stressed with time today, pressed with time. That's why I don't go exactly through the numbers. But if you do that, you will see that the future price that is implied in the at the money option is about 6,061.2. Once you have that, you could of course go back and, for example, check how this is then true for the other options. And I did that for this blue, this call, that actually not these options, which are in the money by about 600. So what I did here, so does put call parity hold for other strikes? For example, this 5,460. You could then, of course, the strike is now lower. That means the put is out of the money, the call is in the money. If you look at the mid price of the put, that's about something like 36-ish, right? And you see the call, and then how do we get the price of the call? We would take the parity to the forward. That is about 600, but remember the forward was at 61.2. That's what we calculated. So the in the moneyness relative to the forward here is about 601.2. I would discount this amount, add it to the price of the put, and that should be the price of the call. Now, when I do that, you can review that precisely after the call. If I do that, I get a price for the call, a mid price for the call, which is about 628.2. Is this exactly the mid price that I see on the screen? Actually, not exactly. You see on the screen, it's about 0.7 higher. But this is quite good because if you look at the bid-ask spread, this bid-ask spread is 7.2, right? So if I get from the puts an implied price of 628.2, let me go back. 628.2, that's very much in the middle. So definitely there's no arbitrage, because if you do an arbitrage, you would cross that bid-ask spread. Here it's quite wide, the bid-ask spread, right? And so on. If you do the same with the strikes of 6,650, you would be even closer. I've chose the example where I'm nevertheless slightly away. So you can see that actually this put call parity is not something that is just on a formula. This is something where you can do arbitrage, and once you can do arbitrage, then the market has to respect it. Otherwise, people who make these markets will lose money. So put call parity, a very, very important concept in when we talk about options.